All right, everyone. Welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer. The views expressed by my co-host today are their personal views, and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode. All right, partner, episode 2 of the AppChain Thesis. I'm excited for this one.
Yeah, this should be a great one.
We're talking to Sam, Hart, and Zaki Manian today, and we're going to be talking about kind of this idea of fat apps. And for listeners, an important analogy or framework that we draw on in this episode is this idea of aggregation theory, which was originally pioneered by Thompson. And just to give you an overview, aggregation theory is kind of a framework for how to understand, a very successful kind of aggregator business model that's appeared in Web 2. So you can kind of think of it as those famous two-sided marketplaces that everyone sort of knows and loves and uses, the Ubers, the Airbnbs, but also even the Googles and the Facebooks, where an enormous amount of value has been captured by aggregating sort of consumer demand around like a specific supply of something that looks commoditized. So I think that using that analogy it's not super perfect for Web3, but it was interesting, to hear Zaki's and Sam's thoughts on where it applied versus where it didn't. And ultimately, I think it was a good way to reform, sort of supply-driven investment arguments that get made in crypto a lot over like demand-driven investment sort of rationales. And, that's what we're very focused on in this episode.
I think we'll get into this in the app, but a lot of these protocols are marketplaces, both L1s that are, a marketplace for Blockspace with applications, as well as the application layer, which is, often a marketplace for, say, liquidity with traders. And just, kind of teasing out where this is going based off of what we see in Web 2 in the aggregator side, and maybe, to think about the benefits of getting closer to the user to have more control over the demand side is a big, tailwind behind this whole application specific thesis. So I'm excited to dig into it.
All right. Without any further ado, let's hop right into the episode. All right, everyone. Welcome back to another episode of Bell Curve. Today, I'm joined by my co-host, Miles O'Neill, and we've got Zaki Manian and Sam Hart on the episode. So fellas, welcome to the show.
It's great to be here.
Thanks for having us.
Okay. Yeah, guys, thanks very much. So we owe a special debt of gratitude to both Zaki and Sam, who gave their thoughts on this season. So guys, thanks so much for not only appearing today, but also helping to steer us hopefully in the right direction for the trajectory of the show. Today we really want to get into this idea of like really explore kind of fat apps versus fat protocols, and really try to examine this idea that value may accrue to the app chain layer, which is closer to sort of consumer sort of consumers that are actually interacting with blockchain. So Sunny was getting into this at the tail end of at the first episode that went live last week. But guys, if I had to turn it over to either of the two of you, just from sort of a high level to begin with, and then we can drill down, if I asked you to make sort of the case that value will accrue to sort of the app chain layer as opposed to the fat protocol layer, do you want to take up the mantle for that argument?
So I view app chains as a way of enabling sort of product market fit across blockchain technology as a whole. And so what the version of that world that sort of exists in my imagination and is slowly starting to be validated by the market is that as you get increased conviction in entrepreneurs about what the market wants, what is needed, what they want to build, you want to be able to sort of vertically integrate that whole experience, right? And usually, if you're building something on a blockchain, you're building some sort of two-sided marketplace where there's a user base and there's a sort of a supply chain or providers on that space, whether it's you're bringing together NFT creators or users or DeFi investors and strategists on SOM. You have this two-sided marketplace. You want to be able to optimize the value flow between all of the parties. And one of the things that is complex about L1s is actually, in many ways, there are a bunch of established value flows in the L1 that you have to contend with, whether it's the like MEV searchers or block producers or miners or all of these things, who are not really aligned with your particular application and who you can't necessarily harness as part of the creation of this two-sided marketplace. And so what I think is going to be the design patterns that will success is applications that do this. Now, one other thing I will say, though, is I think if, like, for instance, if you look at the evolution of the Ethereum ecosystem, you can start your ecosystem as a fat protocol oriented ecosystem, and then things can be built on top of that fat protocol that start to align it better with the application specific thesis. And like I would say both like the emergence of like EigenLayer and the OP stack have been aligning the Ethereum ecosystem a lot better with the application specific blockchain thesis in a way that was like organic but somewhat unexpected.
So I think that, to maybe sum up what you guys said, there are a couple different angles there, which is one, there's sort of the entrepreneur angle, right? Which is that eventually, entrepreneurs are going to want more control basically over the full stack that they're building on. So app chains have a natural sort of advantage there. Zaki, you were starting to, your description of app chains sort of a two-sided marketplace is one that I think is very important. Can you elaborate exactly on what that means? Because I think there are I have a bunch of questions, there are analogies that we could draw there to how that played out in Web 2. And I want to get your thoughts on whether or not you see the same dynamics being prevalent for what we're talking about here.
Yeah. I mean, most applications inside of blockchains, whether or not they present themselves this way, have this sort of two-sided marketplace characteristic, right? And the classic Web 2 two-sided marketplaces are Uber or Airbnb. Uber is, matching a pool of drivers with a pool of riders. Airbnb, a pool of hosts and so, you saw, a sort of cycle. There was definitely a hype cycle of this in general. But in general, you have the classic, even your DeFi apps are just the whole peer to pool sort of thing. Like what this is like, the DeFi summer innovation, which was that you could have these smart contracts that can pool resources and then act as efficient coordination mechanisms between essentially makers and takers in a market a trading application. So you could have the taker side essentially filled by this like LP pool, and then makers on who want to buy and sell being able to draw from that liquidity, or people being able to aggregate their funds in like a lending protocol, and then people on demand being able to pull and borrow from that, sometimes for in a flash loan for one block. These are all essentially the great successes of cryptocurrency have been the creation of these so the problem of Uber, right? The problem of Airbnb is it's not a neutral marketplace, right? Is they are both rent seeking on top of that. And the dream of cryptocurrencies is basically to create these like extremely neutral platforms by which you are able to, match by, the two sides of the marketplace.
Adding on to that a little bit, the analogy, like one of the reasons that Uber works is because it makes the supply of drivers like more uniform for the ride buyer, and it's kind of exactly what's happening to LPs. It kind of gives them a uniform strategy, so it's a much kind of easier interface for a trader to interact with.
So this is kind of a good a good place to introduce, because in those dynamics, right, for Web 2, right? So we're talking about the classic platforms of Web 2, right? Like the Ubers or the Airbnbs. Even before that, you had kind of like the Facebooks and the Googles as some of the best sort of aggregator businesses of all time. This is where, I think it would be cool to kind of layer this idea of aggregation theory, this is Ben Thompson of Stratechery's thing. He wrote a blog post in 2015 that initially gained a lot of traction and has sort of since blossomed into this whole way of describing. It's kind of a framework for describing these very successful businesses in the internet era. And most of them are these sort of marketplace businesses. And we can get into the exact definition of how he defines an aggregator. But essentially, it's these businesses that we're talking about. And really, the key distinction I think that he makes is that in the internet, you can, if you're looking at sort of a supply chain, where that has like kind of production and supply over here and then demand over here, the best businesses in the Web 2 internet era actually optimize for owning demand, right? That's what these aggregators sort of did. So so it was interesting, Zaki, to hear you kind of describe some of the most successful protocols in crypto as actually having a similar dynamic. How appropriate do you think that lens is to apply to crypto? Where does like optimizing for taking demand kind of work in a crypto paradigm versus where does the analogy sort of start to break down from Web 2 in a crypto world?
From my point of view, I think this has basically been the question, right? Is the aggregation of demand at an L1 layer or not? And I think that so you do see aggregation of demand at L1 layers. I mean, I think there's just like no doubt that there is an aggregation of demand, that that networks of like Telegram channels and communities form around L1 and L1 like objects. Arbitrum right now is like where the DeFi cool kids are all hanging out, and there is an aggregation of demand that is occurring around Arbitrum, and and there was an aggregation of demand that happened around Ethereum, and there has been an aggregation of demand around BNB chain. So you do perceive that aggregation of demand does occur. The question that the skepticism around the Fat Protocol thesis, from my point of view, has been that aggregation of demand, I believe, is like largely temporary and transitory and not particularly sticky. And you've seen the aggregation of demand kind of flit from L1 to L1 over the last 3 cycles. And generally nothing sticks. What has been sticky is people use OpenSea and Uniswap, and they use it across multiple chains. And our the core of the belief of this is that the actual aggregation of demand from the end user point of view is not going to be because let's be honest, when blockchains are critical infrastructure and ubiquitous, it's the user base is not going to be we hang out in this Discord or this Telegram group and that's not our user base, right? That's not our long-term user base. Our long-term user base is barely aware that there's a blockchain involved and are just this is a marketplace where I can buy the things I want to buy and use the stuff that I want. I need compute. I need I need an AI model. I need something to be rendered, whatever. They're just, using computing for the services that it provides, and blockchains are part of the infrastructure. So in that work, I need to send money to my friend. They're these are the different things. I need to hedge my Forex risk. All of the ordinary things that people are going to be doing. None of those people are going to be hanging out in Telegram channels and Discords to aggregate demand. They're going to be this is the app. This is the app that does the great job. Does this really well. I use it. I believe in that. That's where my relationship is. I'm at this app layer. And so that's the thesis. It's we continue to be sort of a little bit modeling the future of cryptocurrency based on the future of our space based on the users of today, who are not really representative of what the future user looks like.
I think that's fair. And how much of that do you think is, I guess the difference between, I think maybe another analogy is an L1 is sort of an app, Apple's app store, right? Or Windows, right? In that it's a marketplace for supply and demand of developers, supply of block space. And, it gives them the ability to rent seek throughout that entire, I guess, value chain and squeeze on both sides. Versus other platforms are really owning that user relationship, right? Like Uber, Google, they are the touch point of the user. And so I think, would you agree that you're seeing something where, as apps actually start to gain more leverage and traction on these general purpose L1s, that's part of the friction here, or the tension, right? To maybe move at least to their own app chain, or get closer to the user and be able to, extract more of that value versus the L1. Is that a fair analogy? You'd say that where this is all going is really also the app's motivation to get closer to the user and control more of that value stack?
I think it depends on where you're starting. So if you're starting out as Uniswap, you have a great relationship to the user, and you're trying to expand the addressable market into other chains. If you are starting out as Osmosis and you have an L1, they have expanded into kind of adjacent categories because they want to, one, there's a smaller user base that they have access to at the moment, so they kind of want to get access to users that way. So that question of what move you make and how that kind of impacts your decision about, your architectural decision about the application, and whether you're going to be doing kind of further vertical integration. It really is highly dependent on where your beachhead is, I think.
That beachhead sort of point is I think a good one, Sam. And maybe, there's a lot of work that gets done in traditional businesses of sort of mapping like a customer journey, right? And again, to borrow sort of this sort of helpful analogy, at least for me to understand this within the context of kind of aggregation theory and where value gets captured. Ben has basically used this analogy to describe how people consume information, right? So, in olden kind of times when you were trying to read the news, you'd go right to the newspaper. But in event, and then there's sort of like a value chain of people that actually produce content. And then there's sort of this, there are publishers. But now with the advent of these aggregators in the form of like social media, people actually first go to like Twitter or Facebook or wherever you get your news. And that's why there's a tendency to sort of bypass the middle step for, which is publishers. And that's why traditional publishers are sort of struggling. So when we think about that sort of customer journey for crypto, I'd be curious to see, are there any like opportunities, and what is an aggregator maybe look like in the future end state for crypto? Maybe it's like a wallet is kind of the most obvious thing that comes to mind. Sunny made the observation in the last episode that people aren't users of Ethereum, they're users of MetaMask. So I'd be curious, do you guys view wallets as being potentials for aggregators, or are there other apps, or what is that sort of eventual journey for people into crypto look like, and who has the value capture?
To take a kind of sober look at this, 99% of applications right now are day trading investment applications. It's all financial rails. So of that single category, wallets and potentially kind of like an integrated dApp experience, yeah, absolutely, that makes sense to me. I think if we're really successful here, we're going to be entering into different markets, and we might kind of white label some of this infrastructure for other use cases, or kind of deploy separate instances that really help us do non-financial use cases. The finance is just the back end. So what owning the customer means in that context, I think is, to be written.
Zaki, I don't know if you have thoughts there about just potential, maybe even looking at it today. Even if we just examined the, financial use case or what crypto looks like today. You could even view decentralized exchanges, right, as a potential aggregator. If you think about that customer journey, people will, first engaged with crypto, via, trading on a DEX, although I guess the wallet even comes before that. But, I guess, Zaki, any thoughts to build on what Sam said in terms of potential aggregators today, or even just apps that own sort of the customer relationship or the consumer relationship?
I mean, I think like one of the things that has sort of been most interesting to see, right, is you see both NFT marketplaces and sort of token marketplaces having been remarkably sticky. The numbers that you see are like, I think there was a Blockworks piece that came out recently that was like 3 million of the very large, which is a very large percentage of the total install base of MetaMask, are essentially just OpenSea users, right? And then after you go from the just OpenSea users, I remember, I have no idea if this number is still is true and like what the actual number is, but I remember something like maybe a year ago, someone saying that 40% of the traffic to the Uniswap protocol is sourced from the Uniswap front end, right? In spite of the fact that there are alternate protocols, in spite of the fact that you almost always get a better price from something like 1inch, you still have this like sticky connection to users. And I think we see this in honestly in Cosmos as well, like with Osmosis, like, the Cosmos community is there. That is where, and there are numerous other DEXs in the Cosmos ecosystem today. But the sticky aggregation place for user demand in the Cosmos ecosystem continues to be Osmo.
Does that really come from an early focus on supply of liquidity? I guess that is really, when we think about, both sides of the marketplace, what's more important in the long run. I think it's very interesting to look at Osmosis and how they were able to bootstrap themselves by, using a lot of incentives, frankly. And we're starting to come down on that, right?
Yeah. But they built a Skinner box is what they actually like. I think like what the thing that Osmosis did that has...
What is that, Zaki? Sorry. What is a Skinner box?
So a Skinner box is a system of like very predictable reward. So like you push a button, you get the you get the reward, right? And the question becomes, you are doing this question of, what is this, what is the Skinner box in this scenario? And the question then becomes, you are what Osmosis built was this, every day at the epoch time, they distributed a bunch of LPing rewards, and then people needed to, and so there was this like long period of time of like really of daily engagement with the Osmosis protocol among a large population of early Cosmos people, and I think that was probably the thing that built that user base. And I think the other thing that I think has been successful about these exchanges, right, is probably more than any other application in crypto. It's like it has, the users built a model of like what a centralized exchange was, and then we eventually built DEXs that fit that model well enough that people were like, okay, I get what this is too. And so that conceptual understanding of what it is that you're interacting with, I think, has been a very powerful feature of these systems.
It is an interesting observation because, if you're a builder in crypto, you definitely have to think there's a little bit of a, and I think Cosmos, frankly, is like way ahead of the curve in terms of ecosystems, in terms of like, how can I build the best product? But I think a lot of founders also think of where they're building in terms of L1 ecosystems as distribution as well. And right now, Ethereum has the most users, right, as an L1. But it's a very interesting observation to make, I think, at least to me, that maybe there's less lock-in on kind of the L1 ecosystem if you look at it over time, right? Like users initially, like Bitcoin was the first kind of software ecosystem that attracted the initial developers, and obviously that's not necessarily the case anymore. And today Ethereum is kind of the juggernaut, but like Cosmos and Solana and other L1s have attracted a lot of developers over time. And really, some of the stickiest relationships are actually like MetaMask or Coinbase or potentially OpenSea. So it's just a very interesting observation as to where which apps like might be sticky in a crypto environment, because it's hard to predict. Ultimately, it's still pretty early days for that. I guess just to wrap up this sort of line of thinking, I'd be curious. There are some, when you look at some of the stickiest Web 2 products, especially the sort of marketplace products, it's kind of hard to tease out, how much is aggregating demand versus aggregating supply. Obviously, you have to, when you're bootstrapping those two-sided marketplaces, you need both to happen at the same time, right? So like Amazon with their sort of network of merchants, right? Or Airbnb with its network of hosts and suppliers, or Uber with its, with its drivers, et cetera. I'd be curious, how do you see those moats sort of playing out in crypto? Like when you look, crypto is a little bit of like an open source, like lowering switching costs type environment. Like how do you guys, have you seen any, outside of like the exchanges that we've talked about, have you seen any examples of successful moats in crypto around aggregating demand? Or what do you think that might look like in a crypto environment as opposed to Web 2?
I think it's worth mentioning that the bootstrapping phase is like pretty different from the kind of like maintenance phase. I'm sure you had a similar experience. Like the first time you used Uniswap, like there wasn't really a comparable experience. You were kind of just playing with it. It was kind of the only place to get random coins in 2017. So you were pretty insensitive to anything but just any supply whatsoever being there. That looks pretty different today, where I think that they have like a very strong customer relationship and very strong brand that allows them to be more kind of mobile across different chains, different L2s. And so they've carried their customer relationships so that wherever they go. The moat, the kind of building the moat is, an accretive process that happens over a long time. And I think it starts with like, building the Skinner box early, I guess. And then kind of building some kind of liquidity flywheel or trust flywheel that allows you to kind of retain users.
Yeah, I think that there are relatively few applications with moats in cryptocurrency, which goes back to the general reality, which is that there are very few applications with like users in cryptocurrency. Like the the application layer is continued to lag behind all of the other like hype and bits and pieces and things going on in the crypto ecosystem, right? And so we are there is to my mind not really a doubt here that one of the biggest challenges of imagining the future of crypto is that that at some point, if this whole industry is to succeed, the future has to look a lot less like what the present is.
Yeah, to date, just the absence of bridges has been a big moat, right?
Yeah.
Yes. Yeah, go ahead, Zaki.
Well, I would say there have been a variety of things that have been sources of aggregation of demand at the L1 layer that are breaking down, right? Like USDC also has like availability of stablecoins, and specifically USDC has been a big moat in a lot of ecosystems. But with CCTP, and like sort of Circle's vision of kind of USDC everywhere, that aggregation of demand layer is starting to break down. And I think the other component has been like that. Yes, with the exception of Cosmos, most other ecosystems didn't come with any bridging built in. So like once you got a critical mass of exchanges onboarding onto your platform, you pretty much then that was where everybody stayed. It was hard to, that was you could aggregate demand from on that layer. But like all of those moats are sort of temporary to the immaturity of the industry rather than a permanent features of the system. And so, ultimately what should own, like the only thing that, the last, 60, 40-year history of consumer computing has told us is that applications are really where people like where the stickiness occurs, right? Going back to like the ultimate sticky application like Microsoft Excel.
And I think, a lot of the value of L1 is based off of like how differentiated the apps built on top of them are. But I do think that presents a natural tension, right? Because as those apps become more differentiated, then they're going to want to own, more of the stack and take those users with them. I'm curious how you guys think about Blockspace and this idea on the supply side, right? Is Blockspace is it going to be completely commoditized, or do you see some merit in this idea of there being like a premium Blockspace to say Ethereum L1 that will always, retain a large amount of, I guess, market share, in terms of value to the amount of transactions versus other, sort of environments? Or is Blockspace just going to be completely commoditized across the board? How do you think about validating or invalidating that thesis?
Love this question. I've been thinking about it a bunch. If you look, so my opinion is Blockspace is not a uniform resource. It is so. Blockspace on Osmosis is not the same as like Blockspace on Ethereum, first of all, obviously. And block to block, and even with, interblock or intra-block, Blockspace is not uniform. So it's a highly context-sensitive resource. And the main thing that application-specific chains are doing is basically giving you more kind of granular control over the shape of the resource in the first place, like what you can do within a block or what you can't do within a block, and how the market is structured. So who's able to buy, what the auction or kind of marketplace looks like. I think that there absolutely is some commodity block space. I think particularly for kind of time insensitive transactions. So if I'm like sending a payment to my grandmother or something, I kind of like don't care if it takes like 5 minutes to get there. Like it'll get there. She's not going to check for another like 10 days.
Better hope your grandma's not listening to this, Sam. Just trashing her like that.
But there are there are transactions that you send that can get front run or sandwiched, and that's a very different kind of mode of interacting with the base resource.
So my opinion about the value of block space really comes down to my perception that block space is primarily valued by the accessible network of counterparties in that block space. That like the reason Ethereum block space is valuable is because of the large number of like counterparties and integrations and whatnot. But the problem is, the flip side of that is that there are tipping points in every block in block space or like networks of blockchains, that where you get to a critical mass of counterparties, and then the advantage erodes dramatically. And so I think in a lot of the fat protocol sort of thesis that we're here to we're arguing against and we're trying to invalidate here, there's a tendency to Ethereum block space has the most economic security, therefore it is the most valuable block space, and it's this tautology, right? And I think the actual answer is Ethereum has enormous first mover advantage, has deep integrations with lots of different counterparties, is essentially the de facto first integration point for many services, and therefore has network effects around that. But the likely future is a more of an evening out of that, where there are other places where like large number of counterparties are available and engaged in a system, allowing them to and so how does that translate into the like future value of the future aggregation of demand and the future aggregation of value on Ethereum L1? I think it's an open question. I'm not trying to be completely down on Ethereum. I'm just saying that it's a bit of an open question.
Uniswap is the largest consumer of Ethereum block space. I don't know the exact numbers, but it's pretty significant. I think OpenSea is like number 2 or something like that. And if Ethereum if Uniswap is expanding into layer 2s and other chains, and likewise OpenSea is doing the same, should Ethereum be worried about the value of its block space being eroded because the amount that you pay for a layer 2 transaction is fractions of what you might pay for an L1 settlement? Those are questions that as an AppChain developer, you start to ask yourself.
Yeah, I totally agree. I think number of counterparties and integrations is one kind of lens to look at this. And I think maybe something more lasting for Ethereum L1 is that maybe there will always be some class of transactions that are just so important, right, that people will not trust anything other than Ethereum L1. But on the other side of the spectrum, that to me I could see as being very high value. But on the other side of the spectrum, I think, Sam, you were alluding to it, is being able to really optimize the block space for your application, both in terms of UX benefits and value capture. Where if you think about like MEV, that's where it gets into this sort of stuff. I don't know if what the opportunity is for something that's in the middle of that, but I think in general that's where I see the most value in terms of the block space.
Guys, I've got a sort of a concept that I want to introduce to both of you and the listeners as well. And this is sort of the last analogy we'll borrow from aggregation theory. But there's a concept that maybe even is actually a little bit adjacent to aggregation theory, but it's one that sort of describes where value accrues in different supply or value chains. So I'm actually going to share my screen here quickly so people who are following along via YouTube can actually get a little bit of a visual representation. But the smiling curve is a framework that it was actually introduced from, I think, Acer. Miles, the name of the company. It's a Taiwanese company, and it was used to describe kind of the early PC value chain. And the reason why it's a smile is he sort of bifurcated into three different areas, which is the base part of the value chain, which is kind of R&D, right, and which is secured by patents and technology. Then there's a middle, which is kind of fabrication, and then there's the part that's closest to the consumer, which is marketing, and that the lock in there is kind of brand and service and all that sort of thing. And if you look at where value accrues, the reason it's a smile is because at the very start of the value chain, there's a lot of enterprise value that gets created with patents and technology and kind of that R&D that's very hard to do. Then there's a lot of value that gets created around like the brand and service, right, and kind of the consumer lock-in. But it lags in the middle, which is around fabrication, which ultimately ends up being commoditized. And this is an analogy that has been used to describe like a whole bunch of different industries. I'm wondering if there are places in crypto that this is applicable to, because a lot of what we're describing right now, like I can sort of see the smile beginning to form, like when you think about like app chains or app dedicated block space, right, which ends up being very valuable because it ends up having like a relationship with the consumer, right? And there's some kind of brand attachment and stickiness. Maybe it's at the wallet side, maybe it's at the decentralized. We don't know exactly yet, right? There's an end state, but we sort of see that. Then maybe there's kind of this premium block space, right? Maybe it's Ethereum, maybe it's not, but there's kind of premium block space here. I'm wondering if there's like kind of a middle layer. To be honest, in a lot of discussions I see about like the easiest analogy that I see here is like layer twos. Frankly, like generalized layer twos seem like they are highly at risk of being commoditized. But I'm curious, like when we look at that sort of that smile, does anything stand out in terms of like analyzing sort of crypto value chains, or what do you guys think about that analogy as it applies to crypto?
The ethos of the space is so fixated on one thing that's like very unique compared to the ordinary technology industry is how much of the most R&D heavy parts of the industry eventually get manifested as open source systems, where the technology is where there's no IP protection around the technology, or very limited protection around the technology, or honestly, even if you could put years of R&D into something, and once you release it, it's pretty common in this industry, in crypto, that like if you have something that's a substantial innovation, people are able to clean room re-implement it relatively fast. So like there's a lot, because there's no patents in this space, there's just copyrights really. And I don't expect patents to start playing a major role in this space anytime in the near future. So in that world, it's like basically all you're doing with your, there's this weird feedback cycle where what you're earning with your like very intensive computer science R&D is essentially like a marketing and a brand position. And then the thing that like is the monetization layer and the distribution layer that you earned with doing a lot of intense R&D is the brand, marketing, networking layer, distribution layer.
You already kind of mentioned this, but the smiling curve basically defines like where the monopolies are in a traditional business. Like patents are, intellectual property monopoly, and brands a kind of trust monopoly with the user. And the fabrication process in this instance is commoditized. Although it's kind of changing with TSMC and just the kind of unique fabrication capabilities there.
That's actually TSMC really flipped that on its head, frankly, that story. But that's a story for another time. Sorry, go Sam.
Totally. Yeah, we could talk about that offline. So I completely agree with Zaki. Like patents kind of aren't available to you, and so the monopoly on that side, if you're going to try to kind of retain an R&D monopoly, you basically have to have like a sustained organizational knowledge advantage. So I do think that some of these ZK kind of shops that have have aggregated the best ZK researchers in the space could potentially have a kind of sustained advantage there, but you're not locked in the same way. As well as some like ASIC hardware and now some of the like ZK ASICs, things like that. If you're going to be doing a bunch of research there, and roll out a bunch of those kind of supply constrained machines, I could see you potentially getting a monopoly. But yeah, the vectors of competition are just like a little bit different with the kind of open source mentality.
That's interesting because when I looked at this graph and I was trying to think about this maps over to our space, I honestly thought it from the seat of an application developer that the left side, the R&D side, is something like moving dYdX moving to its own app chain because it can build a differentiated product that way versus any sort of order book DEX that is built on a monolithic chain. And the right side, I saw more as like Uniswap moving to its own wallet, right? Getting closer and finding new ways to build brand and improve their marketing abilities. I guess, do you see in the end game where, these super apps will actually be both, or potentially, if once you move to your own full stack app chain, then you're going to be motivated to build a wallet, or once you build a wallet, then you'll be motivated to eventually move to your own app space.
Well, I guess I would say that dYdX already is that in a way. Like the only reason it's
Yeah.
able to move is because they own the customer relationship.
Right.
They have a fantastic brand. They are the DeFi perpetuals protocol, and users would not go through that kind of pain if they didn't already have that lock-in and like fantastic customer relationship. So I think there's probably, again, just kind of getting back to like where you're entering into the market, like there's probably ways to enter in with like an R&D advantage before people have kind of understood what's going on. I think ZK is this, like there are very few ZK researchers until a couple of years ago, and if you can get a first mover advantage there, you can kind of move into more of like a consumer facing relationship.
That's great. I guess speaking of dYdX, before we came on, we were talking about validation or invalidation signals of this thesis to you longer term. We were talking about the importance of dYdX within that context, right? If this works, I think it's a massive validation signal. Would love to just kind of hear you expand, either of you guys, on that and other, if it's dYdX or if there are other sort of validation, invalidation signals that you're really paying attention to.
I will say that the dYdX, and like I've been working closely with them, and many people in the Cosmos ecosystem have been working closely with them. So this is not purely an outsider perspective, but it is without any doubt in my mind that what we're doing with dYdX will either show will be either like a tremendous validation of the AppChain like thesis, or a demonstration that the pieces are not in place, and the because that that like we have to succeed. They have to succeed. We have to succeed collectively in taking that and migrating that a very high threshold of their customer relationship, which is currently on a StarkX platform L2 on Ethereum, and migrating them to Cosmos. And if we're not successful in doing that, it's a huge demonstration of this is a really this is a problem. On the other hand, one of the other things that I think is most interesting about dYdX is they are legitimately building an app chain. I think a lot of the decentralized exchanges in Cosmos and a lot of the users of the Cosmos SDK are building what are effectively L1s that benefit from IBC network effects, but are not truly app chains. And I think we have a lot of things coming in the Cosmos ecosystem. And I think it's actually a relatively small population of Cosmos chains that have been going down the app chain route. I think we've been trying to do that with some. We are actually been doing that with Sommelier. I think that that the dYdX team, by like, essentially building a custom mempool, building all these pieces, building a thing that is basically there to like allow people to have like the centralized exchange scale and order experience on a decentralized order book. Yeah, or like an order book that like teleports around the world every, 6 seconds or every 5 seconds. Such an amazing vision. I think it can be like people, if it works, will blow people's minds about what is possible with an app chain. That you're like, no, you can't do this on any L1, no matter how fast the L1 is. You can't do this, right? I think it is genuinely an opportunity to blow people's minds about how easy it was to migrate the customer relationship and how and like what is possible in a decentralized setting that I don't think has ever been done before. And so I do think that like that is our right now very much our like the ecosystems like even the entire AppChain Thesis is like sort of flagship endeavor right now.
Zach and I have both done our fair share of like trying to shill the Cosmos SDK and like the Cosmos stack to people, and like usually the kind of two things that first you talk about IBC and then you basically talk about kind of transaction control at two levels. Like one is the fee model and the other is within consensus. And really just this year, I've been really encouraged to see some extremely creative and kind of high performing teams doing kind of innovating on both of those levels. And just these are things that you can't do with a kind of commoditized or monolithic L1. Applications having complete control over every step of the kind of fee mechanism. So that would be kind of early validation for me. But completely agree with Zaki that dYdX, just in terms of kind of magnitude of liquidity and the experience that they're trying to deliver to users would be major validation. Although one instance I don't think is enough to really to kind of prove out the thesis.
That makes a lot of sense, and kind of it's a good segue into my next question. We talked about this on the first episode, but kind of look at this as a spectrum from a full stack app chain like you have with Cosmos app chains to maybe a Celestia sovereign rollup, and then on the other side of the spectrum we have app specific rollups on Ethereum. And I think, Sam, you just got into this a little bit, but what would you point to as the real like marginal benefits in terms of customizations that are possible when you own the full stack as a app specific L1, but versus becoming an app specific L2 or an L3, right? I think a lot of people will look at this dYdX move and it's successful, and they'll say, all right, was that because they own their own Blockspace? And they have more does that same benefit map over to an app specific L3, which is maybe cheaper for me? So I'd just love to kind of unpack what you would, if you were to, shill the full stack app chain, and why full stack over, app specific rollup, or, both today and also maybe, in the future where some things like interoperability are taken care of.
To kind of like couch this a little bit, I think all of these are like valid ways to build an application. That is kind of the Cosmos ethos, is like Ethereum's an app chain. It just like is an app chain that's trying to do lots of things for lots of people. But I do think that there's a certain class of applications that would, really would benefit from full stack control. I think the two kind of largest privacy applications are the ones that I've kind of worked with most closely. Penumbra and Enoma are great examples. Like, it's just stuff that you can't really do, and even on an L2 is very challenging. there's solutions like Aztec, but Aztec has like a 10-minute like finalization time or something, and Penumbra is building a fully private DEX with like, I mean, just the level of like functionality that the users can have available to them is absolutely wild. So, and you need the ability to have the consensus mechanism recognize like the fee token and be able to, validators need to be able to like validate proofs. There's just like a lot that you need to do in integrating the execution with, with the entire application experience. Yeah, and then in the middle there is like modular applications, and I'm definitely like bullish Celestia for sure. And Zaki and I have been talking to them for a long time. I think there's an enormous class of applications that you can build on Celestia. There is a segment that you cannot, and basically the idea behind modularization is that there are kind of defined boundaries between the different kind of utilities. So data availability, consensus, settlement, execution. And the idea there is you're not supposed to be breaking those boundaries. Or they have kind of all these different names for like, a sovereign rollup versus an enshrined rollup. And like what they're doing there is basically they're saying that, okay, in this instance, you're allowed to kind of like to break a single boundary and have this part of the application interact with this other part. And like a fully sovereign application is basically says that, okay, I need like full stack control over every part of every module, because there are optimizations that require boundary breaking, and yeah, so I think that there's lots of different valid ways to build an application.
Yeah, I think that makes sense. I think, people think about app chains, and often the first thing they think of is vertical integration for higher value capture. But what gets me more excited is more about the applications that have that wow factor, right? So something that is a differentiated user experience because it's built on a full stack app chain. And I think teasing out some of those true differentiated capabilities, as you go across the spectrum, and what you lose as you go across that spectrum is really what, we're trying to get a good sense of this season.
That's going to tease into next episode as well, where we really get into the weeds of like, what are the different trade-offs, right, between these different models. And again, there's no like, reasoning by analogy is sort of imperfect by definition, but like there are lots of good reasons, when you look at traditional supply chains of like where to vertically integrate and where it makes sense versus where it doesn't make sense. And you've seen examples of companies and supply chains vertically integrating. You've seen examples of supply chains intentionally unvertically integrating as well, right? To try to give them some relief from, different fluctuations in demand.
I do think that there will be Cosmos applications that like outsource a very specific part of their application stack to another entity, like Celestia, for instance, in order to cut costs and kind of focus on their kind of core business.
I also wanted to put one like last little bit into the whole thing, which is, I don't think we haven't really talked about this in this conversation, but I think it's an important thing to cover, which is the basic idea of the minimum viable application specific blockchain stack. And basically, the way that like I kind of view it as is like the minimum viable thing is some way of sequencing or producing blocks, some way of bridging in and out of the ecosystem, and some sort of toolkit that gets you network effects where you can like integrate with like wallets or and like other and like block explorers and stuff like that. And you don't have to like essentially create the entire universe from nothing. That's what I kind of view as the minimum viable stack. And the question and like what you're seeing is, the Cosmos SDK was the first minimum viable, like the Cosmos stack was sort of the first minimum viable application specific blockchain stack. You are seeing right now the rise of other minimum viable. And so I don't know that I would say that like there's a big difference between like, I expect there to be big differences between like different instances of minimum viable stacks. But what the problem is that we're still at a point where we can't really point yet to anyone else having a minimum viable stack and like compare and contrast it against the Cosmos SDK.
It's a very good point. Very good point, Zach. And a great place to end. And guys, Zaki and Sam, thank you so much for this. Has been a great episode where I think we've really dug into the nuance of some pretty fascinating topics. And I think you've given Miles and I some ideas that we're going to explore for the rest of the season. So, guys, if folks want to find out more about you or follow the work that you do, or what's the best way for people to find out more about you both?
Yeah, you can find me on Twitter at HXRTS. I'm around. Also, pretty available in DMs if you want to learn more about the Cosmos ecosystem.
I'm at ZMANIAN on Twitter. That's usually the best place to find me still for as long as Twitter stays up.
Oh, boy. All right, ending on a dire note there. Guys, thank you so much. This has been a fascinating conversation. Fun. Yeah, we'll have to do it again soon. All right, buddy. That was a great episode. What'd you think?
Really enjoyed talking to Sam and Zaki. I think, we dove into the weeds quite a bit on the first episode with Sunny and Dimitri, and I think this balanced it out a little pretty well by kind of zooming out a little bit and thinking about how to apply a lot of these concepts to what we see of the forces of traditional companies and marketplaces. And I think aggregation theory is a great framework to think about this stuff, and is rarely kind of talked about, I think, in this crypto native space.
Well, I think we came into this episode hoping to sort of reorient our listeners from this sort of implicit bias maybe towards fat protocols to a lens of the world where really value might accrue to the kind of app chain, close proximity to the consumer, and then everything below might get commoditized. And I think we did that, but ultimately I really enjoyed this episode because I think we took a pretty nuanced look at that whole value chain and examined it through like a more traditional lens that you might look at supply chains and exactly those different forces that interact on supply chains. And you get so little of that in crypto because there's kind of this, for so long it's been this magical internet money and normal forces of supply and demand don't necessarily apply. But I think you and I don't have that view, and that you can apply somewhat traditional frameworks or analytical frameworks to where value is going to accrue to this space. And I think we had some pretty fun, discussions around that in this episode.
Yeah, absolutely. I mean, I think I totally agree that most crypto protocols, both applications and L1s, are marketplaces to some degree, matching supply and demand. And we got into really, I think, what is, an observation that I think the focus to date has really been about controlling the supply side, whereas where we think this is going is moving towards these apps wanting to control, and really the apps that own the demand side will eventually have the leverage right over these general purpose platforms, and how that plays out, and whether they're expanding up into wallets or down into chains. I think that teasing out a lot of this stuff was very, very interesting.
I think there's been there's been a bias in crypto towards making supply-driven arguments when it comes to investment. And maybe you can trace that to Bitcoin and its hard cap $21 million coin supply. And you sort of see that borrowed a little bit. I know you think about this a little differently, but in ultrasound money, the ETH meme, and there's been an enormous focus towards restricting the supply of ETH. And frankly, if you look at some of the most compelling outcomes in Web 2, they've been demand-based stories and controlling demand as opposed to supply.
Yeah, 100%. And I think speaking about this in the context of Blockspace is really interesting, because I do see, a future where there could be a premium of Blockspace, which I consider to be, supply on the for say Ethereum L1. But at the same time, the apps are going to want to get more opinionated and specialized with their own block space, both to improve the product, the user experience, and also to improve their amount of value accrual. And so I think there's going to be, it's a natural tension that is kind of the motivation for this whole season, right? And yeah.
And block space premium is a pretty interesting way of framing that. And there's sort of generalized block space, which Ethereum sort of has, and then there's app-specific block space, which is what we're exploring with AppChains. And frankly, I think the jury's still out on which type of block space accrues a higher premium, right? You could see there being like ultra premium block space for decentralized exchanges, for instance, and maybe that's ultimately because it's specialized and that block space you tend to have more granularity and control over fees. Maybe that ultimately ends up funnily being more valuable than any sort of generalized block space. We just don't know.
Yeah, I think I view premium block space more. First of all, there will not be more than one, I think, environment for premium block space, and I think about it more on the axes of like security and censorship resistance, and really making no trade-offs, right, to the benefit of the applications, because that's what you're prioritizing. And I do think that there's probably a space for that, but how much of how much value that premium block space captures versus the rest of the market, and how much activity moves to these specialized app environments where they can optimize the block space for their use case, also impacts how much of that general purpose ETH L1 captures in terms of the overall market cap of the space.
Yeah. The last point that I kind of want to make on this episode was I really agreed with the point. I forget if Zaki or Sam made this point that we are just so far from sort of the end state of crypto, and the vast majority of the use case is people just doing financial speculation today. So it's I think there's this sort of consensus agreement that this is not ultimately how people are going to be using crypto, but it's very difficult to get a line of sight to what that end state does look like, because we're a little ways off from that right now.
No, I totally agree. And say we were in a world where there was thousands of applications, decentralized applications that are used by billions of users. I think at that point you can see like an obvious aggregator in terms of something like a super wallet, right? That is basically in the same way that search helps people sift through the internet and basically go from intent to action faster, right? You could see a wallet kind of doing the same thing, but today there's just not enough valuable activity to aggregate. And so, I think there's still a lot of green space there, both, at the application level. And maybe the applications become their own wallets, right? So, I think that we are still so extremely early, and it's hard for an aggregator to exist when you're this early.
100%. The wallet idea is an interesting one, because you and I sort of went into this episode thinking if there was something that looked like a Web 2 aggregator in Web 3 or crypto, it's probably wallets. Jason's been talking a lot, and he did an episode on Empire about wallet wars. And it's just funny because you can go all the way back. People were talking about the wallet wars in 2017 or 2016. You can actually find threads on Twitter. And on the one hand, you haven't really seen that play out. Like a lot of people thought that wallets are going to be more important than they are. On the other hand, you look at something like MetaMask, and it has early indications of it being sticky. For no offense to MetaMask, there are a lot of flaws with the product, I would say. Like nothing, it definitely could be improved on, and yet it still tends to be a very sticky thing that, like, I'm the same way. Like MetaMask was my first wallet, and I use it, primarily for the vast majority of what I do.
Yeah, I totally agree. And that's why I think that, differentiating in terms of a general purpose wallet hasn't really been able to, unseat MetaMask, but the real signal will be the success of Uniswap wallet and OpenSea wallet, right? If some large percentage of all MetaMask transactions are attributed to those applications, and then those applications build their own wallet, right? That will be a big signal to see just how many of those users migrate, right, to the apps that they're using most, and the wallets for those apps, right? In the same way that I think dYdX is also a big, validation or invalidation signal.
And we knew dYdX was a big deal going into this season. It was interesting to hear from Zaki and Sam just about how much of a bellwether or an forward-looking indicator this is for sort of the whole AppChain thesis. So no pressure, Antonio.
Yeah, exactly. We're all counting on you.
Got the hopes of a whole sector and idea riding on you, buddy. So good luck. Miles, you want to talk a little bit? We started to get into the very last portion of the discussion about sort of trade-offs between a full stack monolithic app chain versus one that's more modular, sort of the Celestia model versus one that's sort of built on Ethereum. We were kind of getting into that design space difference. And that's what we're going to be focusing on primarily in the next episode. I don't know if you want to tease it a little bit.
Yeah. I think, as I've said before, that's really kind of digging into the differences in terms of what you can do with the product, what you can get in terms of value accrual between a full stack app chain to a modular, app specific rollup to an app specific rollup on Ethereum, either L2 or L3. That's one of the biggest questions for me in this show. And I think that, Zaki, I liked his framework that he used around, a minimum viable stack, right? And so far we've only seen, apps in action that are using the Cosmos stack, but soon we'll see, basically a stack emerge on the modular side. And we're seeing lots more, I would say, roll-up stacks emerge on the Ethereum side, whether it's Bedrock from Optimism or Slush that's, building an SDK for Starknet roll-ups. And just, kind of mapping what the benefits are from the Cosmos SDK full stack to those other minimum viable stacks and seeing just how many, you can bring with you. Because frankly, the Cosmos full stack is expensive and it is risky. And we don't have a lot to compare it to yet. So, I think we'll talk to some folks on the next episode who are in a great position to kind of dive into that. And I'm really excited.
It's expensive and it's risky and it's hard. Sam kind of made this point right at the end of that last episode of you might actually see some chains that started out trying to be full stack, monolithic app chains. They might actually say, hey, if you've got, kind of execution and product, and then there's like all these things that need to happen underneath, settlement, data availability, consensus, maybe we don't really want to do all that because like bootstrapping a network of validators is not what we do really well. We want to just focus on that top app chain. And lots of examples of this, again, in traditional supply chains of like just wanting to focus on the one area that you want to play and you have a competence and you'll outperform. So it'll be interesting to see if we unverticalize or
unbundle the stack, right?
Thank you very much. Thank you. Yeah,
right.
Unbundle the stack. Yeah.
Yeah, I think it'll be interesting to see how much of the the stack is unbundled, and also I think what Zaki got into is how much horizontal expansion will app chains be able to accomplish without I guess dealing with scope creep and really deteriorating the UX of the core product. Like we're seeing a lot of sector specific app environments or app chains now. So yeah, I think lots more to come on the season, but the next one should be a great one too.
Agreed, buddy. All right, I'll see you for that episode.
Sounds good. See ya.